Today, we will examine why accounting for our federal assets matter and why inaccurate monitoring can bring economic harm to both borrowers who pay higher interest rates to cover the defaults of others, private lenders who are frozen out of markets they seek to serve, and taxpayers who may be exposed to unqualified losses. During my prior service in the Senate, I was one of the nay votes for the Omnibus Budget Reconciliation Act of 1990. 25 years later, I never imagined that I would be chairing a hearing to debate the impact of accounting rules passed back then. This situation reminds me of an old Yogi Berra quote, "The future ain't what it used to be." The 1990 reconciliation law included the Federal Credit Reform Act, accounting rules crafted in reaction to the rocky credit history of the 1980s. The Resolution Trust Corporation held the assets of failed savings and loans and put the federal government in the loan workout business. Sadly, fraudulent student loans made during that decade led to a 20% student loan default rate and a loss equal to almost 10% of outstanding loans. Cash accounting for all these asset changes within a budget year presented a volatile picture of the federal budget that properly represented spending trends. Since then, the federal government has followed the rules of FCRA, recording an annual present value adjusted, quote, subsidy cost to account for losses it may incur in the future charged against loans it has made directly, as well as guarantees it provided for loans made by others. It took 10 years to refine the complicated net present value calculations used for FCRA, but by 2002, government accountants calculated that the federal portfolio of $1.3 to $1.4 trillion in loans and guarantees generated annual subsidy costs in the range of $5 to $12 billion. This brings us to the financial crisis of 2008, which ballooned the government's loan assets. FCRA's accounting rules converted loan subsidy cost into deficit reducers. Since 2008, government accountants have booked nearly $200 billion in annual subsidy gains, while the amount of federal loans and guarantees has more than doubled. As a result, it is clear that the more credit market exposure the government takes on, the more that expectations of future revenue rise under the current accounting rules without equal accounting for higher risk. At the end of September 2014, loans made or fully guaranteed by the federal government totaled over $2.9 trillion. This includes $1.1 trillion in student loans. Additionally, the Federal Reserve reported that non-mortgage consumer debt totaled $3.3 trillion as of September 30, 2014, giving the federal government a 1/3 share of the U.S. consumer loan market. Add that to the 70% of the mortgage market that the federal government holds through direct loans guarantees and Fannie Mae and Freddie Mac, and the federal government is the largest consumer lender in the country. A lot has changed in those 25 years. So today we must ask ourselves, do accounting rules passed 25 years ago reflect the complexity of today's financial world?